Hello and welcome, accounting students. In today's lesson, we are going to be revising partnerships and focusing on unique transactions that obviously affect partnerships. Now, before we get started, make sure you've got pen, paper, obviously your calculators in front of you so that you can work with me. Okay? Right, let's begin. Okay, now obviously you have been the accountants of a sole trader. So have you ever thought about, have you guys ever thought about how does the form of ownership change the accounting process required? So when we're talking forms of ownership, going back to, once again, grade 10 accounting, where you were the accountants of a sole trader, how is the accounting process now going to change now that you've become the accountant or bookkeeper of a partnership? We're also going to be looking at how does owner's equity change when there is more than one owner. Again, sole trader, there is just that one owner that provides all the capital. But when you're looking at a partnership, obviously you've got two or more owners involved in the business. Okay, so that's what we're going to be focusing on. Let's continue. Right, now to give you the entire picture, obviously the topic is partnerships, and you're going to see in today's lesson, yes, we're going to get to financial statements, we're going to get to analysis, but in today's lesson, we're focusing on transactions, which means I want to also look at, while we're looking at transactions, the accounting equation. Okay, so let's carry on. Right, some key words that I want you guys to take note of that I'm going to be discussing during the course of the lesson. Change in ownership, which we've already touched on already. Then we've got the partnership agreement, very, very important. We need to know what is that agreement between our partners, as well as the concept of unlimited liability. So when we talk about liabilities, we're not here referring specifically to the liabilities of a business, but more the liabilities of the partners. Okay, so these are some of the concepts, some of the key words I want you guys to take note of. Right, so what is a partnership? A partnership is a business which is owned by a minimum of two owners that are referred to as partners. So remember, obviously, when you were doing a sole trader, you've got just one owner, but in a partnership, you now have two or more owners referred to as partners. Then, if we continue, in a partnership, the owners or the partners bring together knowledge, expertise, skills, and capital into one business. So remember, guys, if you are now forming a partnership or you're going into this joint venture with another individual, you are then expected, or both individuals rather, not just you, are expected to bring in some level of skill, knowledge, to bring in that capital, that money, to be invested in one business. Okay, let's move on. Right, now as the bookkeeper, you are interested in how does my job change? How does the accounting records that I'm going to prepare, how is that going to change? So let's focus on that. How does the accounting records change? Each partner's capital contribution is recorded in their individual capital accounts. Now, this is very, very important. We're going to touch on this later on, but remember, you've got two different individuals bringing in a certain amount of capital, so this needs to be recorded separately in their own capital account. Got that? Right, let's move on. A partner may increase or decrease their capital contribution. Now, once again, this is something we didn't come across in sole traders. Remember, you had your sole partner, not a partner, let's say that again, sorry guys. You had your sole owner contributing all the capital, and in a partnership, however, because you've got two partners, the partners could at any point in time increase their capital, but they can also decrease their capital depending on that partnership agreement. Right, let's move on to the next point. Any withdrawals. Okay, so withdrawals, obviously we're referring to drawings. So any withdrawals, for example, they may take cash from the business. The partners could take stock, stationery, or fixed assets. So any withdrawals made by partners are recorded in the individual drawings account. So just as we record capital separately, we're going to do the exact same for drawings. Okay, you guys got this. Right, let's move on. Still with how does the accounting records change? So we spoke about capital, we spoke about drawings. Now let's look at what happens at the end of the financial year. So at the end of the financial year, at year end, net profit and drawings are not closed off to the capital account. So as in the case of a sole trader, a current account is then used for this. Right, so once again, guys, this is obviously reminding you of the various unique transactions that you would come across while doing the books of a partnership. Right, and then finally, the last point in terms of accounting records, net profit is shared, appropriated as per the partnership agreement. So remember, when it comes to that final profit, that profit obviously belongs to the owner in the case of a sole trader, but when it comes to a partnership, that profit now needs to be shared. The correct accounting term is that profit is appropriated between the partners. Okay, so that in a nutshell are some of the unique transactions that we're going to come across while doing the accounting records of a partnership. Right, so let's move on. Okay, so something that we would have covered already, but remember this is revision. So let's go back to what is a partnership agreement. So obviously an agreement, you've got two people coming together, discussing certain terms and reaching some kind of settlement, reaching some kind of agreement. Now, obviously, when you form a business with another individual, it's always important, it's advisable. Talk about the business, talk about your responsibilities, talk about capital, net profit, and everything concerning that business before you start the business. You're doing this in order to avoid conflict, which could happen later on. Okay, so let's recap on what is a partnership agreement. It's obviously an agreement between two or more partners in a business which will list the following. Okay, let's say that one more time. So it's an agreement between two or more partners, and in that agreement, you are listing the following. So you will obviously mention capital contributions per partner in that business. What is the knowledge, what is the skills or goodwill that each partner contributes to the business? So remember, if you've got a doctor and a dentist coming together and forming a partnership, obviously they will bring into that partnership different knowledge. One is a doctor, one is a dentist. What do we mean by goodwill? Goodwill refers to that reputation that they could be bringing. So you could have a doctor, he's got a good name in the community, he now joins forces with a dentist, he then brings that goodwill, that good name into the business. So this is this is actually an asset. I know we don't really do much in accounting, but goodwill is a type of asset that is brought into the business. Then each partner's portfolio or responsibilities are also discussed. Distribution of net profit. This is absolutely important. How are we going to share that net profit? Including the annual salary, right? The percentage earned on capital that is contributed. Here we're talking about the interest that is earned, not percentage. It should be interest earned on capital. Sharing of remaining profits, or in the case of a loss, how is that loss going to be distributed amongst the partners? Right, and then also included in that partnership agreement, to what extent partners are liable for debts. So when we talk about debts, we are now referring to liabilities of the business. And if, for example, the business doesn't work out, there's terrible losses, obviously you've got to pay your liabilities. To what extent are the partners and their personal assets that could be seized in the event of that happening, to what extent are they responsible? Remember, in most cases, partners have unlimited liabilities. They are responsible for business debts. Okay. Right, a bit more theory before we get to an actual exercise itself. I think, you know what, guys, maybe we should take a break before we continue. But remember, obviously, we're focusing on partnerships, and we are, in the next segment, going to now look specifically at the accounting equation with those unique transactions that I mentioned earlier on. So I'll see you guys in a bit. Go and grab a glass of water, and when we return, we will continue.